become a CFS in the last 10 years, right? So the only addition that has happened is the 25 acres that we have added to our facility. What that means is that as the cargo and the volumes increasing in Nhava Sheva, the supply demand is now going to be changed. So earlier there was a oversupply of CFS with respect to the terminal volumes that we were handling. As years pass, and by 2027, as we have mapped, by 2027 we are actually kind of getting into the deficit positioning of CFS with respect to the volumes of the terminal. This actually starts giving us better revenue, better yield, and better ground rent storage stories coming in the future. And this is not too far. We are talking about 26, 27, 28 is where we see this happening once PSA second phase is completely running into the system.
Okay, thank you.
To the last point you made that the demand supply situation is now reversing, can you comment on what sort of utilization is the industry at in some of the key ports that we have, maybe JNPT, Mundra, Chennai?
So let's put it like this. I'll give you demonstration from our numbers starting from, let's say, from 2017 vis-a-vis to what we are in 2025 and how we look at 2028. So 2017, we were actually about 2.5 times capacity CFS more than the volumes that we were handling within Nhava Sheva as a local Nhava Sheva volume. 2025, we have come down to like where we say like most of the facilities are 80 to 85% full or being utilized. By 2027, we will be at least 15% lower than your capacity will be 15% lower than what the terminal capacity is going to be. So by 2027-28, we are actually a 15% deficit capacity in CFS with respect to the port volume that is going to be added into Nhava Sheva. If you look at the other port terminals, Chennai as a facility as Chennai is already overcapacitated at the moment. So most of the Chennai facility is working at 85-90% efficiency. What we are doing, we are building up facility in Kattupalli or looking for facilities in Kattupalli to build our capacity, and that's where the work is in progress. Mundra, again, whatever the SCZ capacity of CFS is there, most of all the CFSs over there are again 85 to 90% full. So we have taken the extra initiative of getting into a land parcel of 60 acres outside the facility, outside the SEZ, which kind of brings us again into in between Tuna Tekdi and Adani, and we build our capacity there. So overall, I think so. What has happened in the trade is because of the government had actually kind of stopped giving CFS licenses and ICD licenses. They managed to kind of bring the supply demand story in line now, and we see now like the things are going to be more reversed because the capacity of port has increased faster than what is the CFS ICD capacity. So hope that answers your question.
Thank you so much. And on the Farooq Nagar facility, can you comment a bit more? How much investment would that take in absolute terms, and what sort of revenues and profits do you expect from there? And how much would you want to own the land and the infra, or would you lease that?
So to answer the first part of your question, we are expecting to invest close to 200 crore in Farooq Nagar facility. It will be a mix of own as well as lease land parcel, which we are looking to have here. In terms of profitability, traditionally ICD business do have slightly marginally higher profitability as compared to CFS ICD business, which will be a case for Farooq Nagar as well. Farooq Nagar would also have rail revenue coming in because we will be venturing into rail freight business as well. So that would basically give us better yield. and also marginally lower EBITDA because rail freight business would be more a volume driven business where the volume would be a key factor. So just to answer your question, basically 200 crore of investments in Farrukhnagar project which we are looking at right now from here on. An ICD margin in line with our existing business, slightly higher maybe.
Got it. Thank you. And the existing competition in Farrukhnagar, the two that you had identified, how much capacity do they have?
So Farrukhnagar, like what on NCR, we are basically surrounded by 6 other ICDs at the moment. So we are looking at Dadri, we are looking at Panipat, so we are looking at Sonipat, and where Farrukhnagar is present is we are exactly in the center of all these ICDs. What we have done is we've done a mapping of 0 to 90 kilometers with existing factories and companies that are evolving cargo from there. Our Mundra to Farrukhnagar, the timeline that we save is, I think so, covering that 90 kilometers of deficit or the 90 kilometers of extra kilometers that we might have to work with. But the one day saving is going to be more beneficial in terms of cargo connectivity. So for us, like it's the six ICDs who we are going to not compete with, but possibly beat it, and that's what we are working on now. You have the diagram over here, so you can just see what we are talking about.
Can you share some thoughts on our existing investments in Dadri joint venture with Concor? Where do we stand? How do you see vis-a-vis this, whatever new plans you have? And what's the EBITDA per ton there? Per TU.
So the Dadri investment we have done a few years back. We have invested 5 crores in our joint venture at that point of time. And we are holding 51% stake in Dadri joint venture. The profitability has been, I think the revenue profile of Dadri ICD business is more or less in line with our CFS business. I would say revenue per TU, which currently overall business we are doing 12,000 rupees per TU as a revenue per TU. In Dadri also we have got similar profile. In terms of profitability, currently we are doing EBITDA per TU close to 2,200. Dadri profitability slightly higher as compared to that, but I would say not too much of a difference in terms of what we are drawing from Dadri ICD as of now and what we are doing in our rest of our CFS business.
Yeah, going forward for next 5 years, what's the view on that?
So Dadri joint venture will continue. We'll continue that joint venture and we will look to add more capacity as the market is growing there also. But as of now, there are no firm plans on Dadri. We are focusing on the 4 projects which we have mentioned here, and that's how would be our growth drivers going forward.
So just to conclude, the capacity of Dadri is now over. So basically, the joint venture that we've had with Concor, there are 4 other joint ventures which run into Dadri. So there is no more scope of expansion within Dadri, neither for Concor, neither for us. Like, so what we've done is we've already exhausted our capacity there. We're doing a very stable business. If you see our eclipse over here, it's basically taking care of Farrukhnagar. We are talking about Bawal, Sona, Faridabad, Sonipat, and then Bhiwadi. So this is our encashment area for Farrukhnagar. Dadri is a very, very stable business. It's a kind of annuity business that is going to continue, and it will continue with our JV with Concor.
Yeah, and the second question is your EBITDA per TU is moving from almost 1880 or 1900 to 2750 in next 5 years. So can you share what is that actually going to contribute and which is the major leverage which will come in?
So, if you have gone through the projects which we are executing, the first project which we have already executed is JNPT capacity expansion. This is purely on OPEX model. We have invested minimal capex there. And this particular facility is just adjacent to our existing ATL JNPT flagship capacity. So this addition has happened without any increase in overheads. So straightway, whatever margins we are doing there is getting added to the bottom line. So that is the one big push which we are having when we are talking about EBITDA per TU. Another example I can give you for our facility at Mundra. So Mundra, we have acquired 60 acres of land, and the plan there is to basically, in future, once the facility is ready, to consolidate our operations there. So that will give us substantial saving in terms of rental and also the cost efficiency. So I think our projections of improvement in EBITDA and improvement in EBITDA per TU is based on these plans which we are there. It will be driven by a lot of consolidation initiative, lot of operational efficiency, which we are planning going forward. So that's how we are looking to improve our EBITDA per TU in the long run.
Thank you.
Just to add the earlier point with regard to Farooq Nagar coming in will also help in driving the EBITDA per TU.
I mean, like, I was puzzled by revenue per TU moving by 2,800 and TU delta coming somewhere around almost 850 rupees. So that's why I was wondering whether 30-35% can be captured so easily.
So can you just repeat the question for more clarity?
So revenue per TEU is moving from 11,400 to 14,000. So there is a hike of just 2,800 rupees, whereas EBITDA is moving from 1,880 to 2,750. So what we are capturing is against 2,800 rise, almost 900 is getting increased, converted into EBITDA.
I think if you were to look at the current EBITDA, we are running at close to 2,200. So that's the first number that you might want to kind of check. So I don't know where you're reading these numbers from. We can just talk to you offline, and
Sure.
the current EBITDA, the previous quarter EBITDA per TU is 2,290.
We'll take it offline.
Yeah.
I have the numbers which is from
We'll-
the same
yeah,
slides.
we can look at it.
Yeah, two questions from my end. I'm over here. So first question is with port operators venturing into the logistics space and predominantly the top two operators, do we envisage headwinds to our volumes, especially at the locations where these operators operate?
Can you just rephrase the question? I mean, I didn't
Sure.
get the first part of it.
Sure. So with port operators like Adani and JSW venturing into the logistics space and trying to capture that part of the supply chain, do we envisage headwinds or competition from these port operators, wherein they'll obviously have an upper hand in getting the volumes from customers which usually park their containers at our locations at our CFS? Do we envisage any headwinds or competition from these two guys?
Yeah. So I wouldn't say headwind. I think so. It's a healthy competition. I think that what JSW is building, JSW is not building a container freight station story. JSW is trying to build a more domestic ICD story, right? So JSW is actually trying to cater to a lot of their in-house supply, and that's how they are acquiring certain positions and stuff like that. In terms of terminals, JSW still is running very, very small ports, and now they have entered into Kolkata. So that's not a market that really comes into our gameplay. Adani again has not a CFS player. Adani is again a more domestic ICD player along with its terminal with a rail connectivity. So it's a healthy competition, but not a headwind, I would say.
Sure. Second question is on a comment that you made that customers basically use CFS to sort of ride out spikes in container shipping rates or freight rates. In the current environment where container shipping rates have moderated, does this opportunity sort of downsize for us?
So I think it's a good question. So if you were to look at it, we stand to benefit on both ends. So if there is a longer dwell time, which ends up happening at the CFSs, there is a certain amount of ground rent realizations that we do. But given the capacity in which we operate, if the containers move away fast, then we make money with regard to faster turnaround. So it is, in a way, a win-win situation. It's not really something which impacts us. So if you were to look at it, there are times in which dwell times increase, and there are certain set of customers and certain set of commodities which end up being in the CFSs for a longer period of time. So that will be there. And there are a set of customers and a certain set of commodities for which the dwell time is less, for which multiple turnarounds help us make money with regard to the transportation, with regard to the handling charges and the allied services that we do. So it kind of balances. That's how I would put it.
Sure. Just one last question on our aspiration targets. I think we are forecasting about 8% volume growth and 13% revenue growth. Are we building in certain value-added services? How are we building this realization growth?
Yeah. So that's where the Farooq Nagar angle also starts to come in. So in the 1 million TUs that we are projecting by 2030, there is about 10 to 15% of those volumes which start to come in from Farooq Nagar, which has better revenue profile compared to the rest of the CFSs. So that is one. Second, over the last multiple quarters, we have started to see tariffs not slipping back like what it used to do between 22-23. And that is linked to what Ashish said. In most of the locations, CFS capacities are starting to get filled up. And I think that will kind of ease the pressure on tariffs, which is something that we have been going through. That also is something that we have factored in.
Got it. We're not building in any tariff hikes or we're building in marginal tariff hikes.
Marginal tariff hikes, and wherever there is an opportunity to value add with regard to labeling or any of those kind of opportunities which are possible, I think we will get into that, and that has additional revenue streams that we will build in.
Thank you.
Hello.
Yeah.
Yeah, here. Hi. This is Anand from My Temple Capital. Thank you for the opportunity. Sir, so what is the total capital expenditure that we are planning to do till FY30 for the targets that we want to deliver? And are we further planning to dilute any equity beyond the warrants that were recently issued to the promoter?
So the overall capex that we have envisaged, I shared with you, we are envisaging on top of what we have already spent another 400 crores for the projects. So we have currently spent about 150 crores for these projects. On top of that, another 400 crores. How this will be funded, the warrants, I'll request Preetham to kind of share those details with you.
So the key source of funding this capex expenditure, first source would be our internal cash reserves, which we are having currently, plus the strong internal accruals which we are having. As of now, the existing business, as we have said, that there is a very efficient working capital management, is generating good cash flow, and a lot of this investment would be funded by existing cash flow. We are looking to have equity infusion up to 120 crores for capex purpose basically, and the most of these investments are coming in FY27, wherein we would also go for a bank loan to bridge the gap for a short-term purpose. But otherwise, I would say a major portion of the investment would come from our internal accruals, then equity infusion and some bank funding for a temporary period.
And the investment that we've done in HORCL, the 110 crores, that's mainly a strategic investment to secure the rail network to DFC, or I mean, what kind of profitability do you envisage from that investment?
So I think the primary purpose is to get the rail connectivity. So, and I think this is a very large project, the HORCL project, and it's a very long gestation project. So we are not really looking at that capital appreciation or the returns from that at this point in time. For us, Farooq Nagar is important. This gives us access to the DFCC, which builds an USP for the customer. That's how we have thought about it.
And the investment in Farooq Nagar that you mentioned about 200 crore, that's on top of the 110 crore that we've invested in the HORCL, right?
Yeah.
Thank you.
Are there any other questions? Okay, if there are no other questions, can we close the Q&A session? Thank you, Mr. Suresh Kumar, Managing Director of All Cargo Terminals, Captain Ashish Chandana, Chief Executive Officer, and Mr. Preetham Vartak, Chief Financial Officer of All Cargo Terminals. Thank you. Moving on, we move on to our Surface Express and Contract Logistics business under All Cargo Gati and All Cargo Supply Chain. May I request Mr. Ketan Kulkarni, Managing Director and Chief Executive Officer of All Cargo Gati, to kindly come up to the dais.
Thank you, Jyotsna. I see a lot of people from the back moving out. Should we take a 2-minute break? Those in favor, please raise your hand. Yeah, there are a few who have raised their hand. So let's take a 2-minute break. I think it's been 2 long hours. A lot of heavy duty presentation and numbers from my colleagues in the group. So I'll kind of give you some time to loosen the limbs. Thank you, and wait for all of you all. Yes. This is my iPhone 17. gave the break because everybody was just sitting in a better mood. Maybe I missed it for myself. They'll ask more questions. Now they're refreshed with tea and. We are scheduled for a 7 o'clock hard stop. Is Dharmesh ringing the bell? A new role he has taken. Nayan has moved out. Nayan has moved out. मैं बोल रहा था राहुल बहुत बड़ी गलती है अब चाय भी पिएंगे खाना भी खाएंगे कोई क्वेश्चन इसने एनर्जी दे दी Shall we start? What did you do? You're outside. Inside वाले तो settle down है already. Should we ask some of our colleagues to go out and call the members? That's done. Thank you. Generally, they have this bell that rings in most of these convention halls. Do they have one outside? Shashank, can you check? We good to start now? Yeah, but it's good, na? They got a break.